Markets this week are continuing to hit records, more all-time highs for the Nasdaq and S&P 500, and it's official. Nvidia now topping Apple and Microsoft to become the largest U.S. company. What should traders do now, and what sell rules should they be using? Well, we'll tackle that and more on this week's show. Welcome, everyone, to the Investing with IBD podcast. It's Ali Coram here, in for Justin Nielsen this week. I'm IBD's executive editor, multimedia. You know, they had to get the third string in. Justin on vacation, Scott St. Clair too. So you're stuck with me this week, but we have a familiar face for you all, and that is, and a familiar voice, because this is a podcast after all, and that is Arusha Pierce, portfolio manager at O'Neill Global Advisors. Great to see you, Arusha.
Yeah, great to have you back, Ali. The GOAT is back. Yeah, you were one of the OGs of the podcast. Yeah, it was both of us working together.
It was me and you. The duo is back. I was
Right.
the OG producer, you the OG host. So we're gonna make it a great show this week. Justin's just missing out.
Well, no, I mean, it's always a good show when Justin's there, not here. I mean, and on vacation. So, Justin, have a good time on vacation. You don't have enough of those, so enjoy.
We will. We miss you, Justin, and we're looking forward to having you back. We're also looking forward to getting insights from this week's special guest, another familiar face to those who watch IBD videos and listen to the podcast, and that is Joe Fahmy, portfolio manager at Zor Capital. Great to see you, Joe.
Great to see you guys as well. I'm excited for this. Thank you for having me back as well.
Of course, it's always a good time. So, Joe, we're seeing a lot of strength in the major indexes, not only in the last couple of weeks, but if you take a step back and look at the last 6 months, year plus. So would love your take on that step back look at the major indexes and the overall market action right now.
I'm a big fan of looking at the bigger picture, because the best traders, investors I've studied, they seem to have a good grasp on where we are overall. And we talked about this on IBD Live and in earlier podcasts, that I believe this bull market started in May of 2023, powered by AI. Big moves in the markets and big run-ups in the market, strong uptrends tend to be powered by inventions, innovations that revolutionize and change our lives throughout history. We've talked about this before: railroads, airlines, television, PCs, smartphones. The list is endless. And what do all of those inventions have in common now with AI is that they all help to increase productivity. So I think bigger picture, we need to take a step back and realize that that's what's, in my view, that's what's powering this market. Now, the start of the bull market is subject to interpretation. Some people say the October of 2022 lows. Some people say, May of 23. It doesn't really matter. I'm going with May of 23 because I want to make a point here. William O'Neill talked about when we start to emerge into a new bull market, the leaders tend to show right away. And Nvidia has been the clear leader. And that's when in May of 2023, it had that big gap up on the huge guidance. So that's why I'm going with that start date. And then also, bull markets tend to last about 3 to 4 years. So we're about year one into this. And of course, we're going to see corrections and pullbacks along the way. But I just like to use that as a backdrop for sort of bigger picture theme.
Okay, so Joe, now we can stick with the bigger picture, and we'll take even a bigger picture. And this goes really referring to your tweet that you sent out last week, the macro view, and we've heard a lot of macros talk over the last year or so, and there's been a lot of negative stuff, many reasons, fundamental reasons to be negative, and even still now, fundamental reasons to be negative. How do you incorporate, or do you incorporate the macro, or what's your opinion about the macro into all of what's going on in the markets?
I think macro is just 2022, 2023. I think it was a bigger deal when the Fed was raising rates.
Okay.
Now that they have signaled that they are stopping, and people are arguing whether they're going to cut this year or not, but the whole point is that they've stopped raising rates. So in my view, the macro doesn't matter as much because the Fed has stopped raising rates, inflation's coming down, and I've noticed that these big reports that everyone hypes up to be the biggest report and the granddaddy of them all and all this stuff, the market just doesn't care. It's not the news, it's the market's reaction to the news. So
Right.
it was a bigger deal back then. My interpretation and my view is it literally doesn't matter anymore, or not as much. And when it does matter, we'll see it in the charts and in the tape.
Yeah, I mean, especially because of the kind of gains that we've seen this year for the indexes, and the goalposts have been moving all year. First, it was 6 or 7 cuts, then it was 3 to 4. Now it's maybe 1 this year, and we've still continued to climb higher. So it does seem like, to your point, a lot of the strength is on the, I guess, on the back of this AI theme. It's not just AI, but it really is this transformational technology that is shaping the future for a lot of the way that we work and productivity, to your point. So here's another big picture question for you. We've talked previously about looking at 2003 as a precedent, but with all this talk of AI and the market continuing to run up, we're seeing more of these stock splits now with the likes of Nvidia. Chipotle is going to have the biggest stock split, or one of the biggest stock splits in New York Stock Exchange history, coming up in a couple of weeks. Are you seeing more parallels between the current market and the .com era, Joe?
I do see some, but I still think it's in early stages. The other big difference is the .coms was, stocks like Yahoo and AOL, they'd report earnings like 3 cents versus 1 cent, or 2 cents versus a loss of 7. The insane earnings power from these companies is on a whole different level. So there are some parallels, but the earnings power is incredibly strong. And I still think this is in the fairly early stages. When people are saying, well, what about a bear market? Let's not forget, we just came out of 2 bear markets in the past 4 years. We had the 2020 bear market during COVID, and then when the Fed raised rates, which was unprecedented. We've never seen 500 basis points raised in the history of the markets in 12 months. So that led to a bear market, about a 40% roughly correction on the NASDAQ. But we're just coming out of that. So the parallels is more of, if this is 03, 04 in the early stages, if this is 95, 96,
Right.
it's the earlier stages of those 3 to 4 year moves, again, with corrections along the way.
And what about just participation and breadth, right? The breadth is pretty narrow right now. Participation continues to drop. There are a lot of stocks that are starting to break support areas. How do you take that into account?
I think, I mean, maybe I'm just too optimistic, as far as, I think in the market, there's the haves and the have-nots, meaning Wall Street wants to see growth. There are companies that are growing and there are companies that aren't. And I'm just trying to focus on the best. And it's not just AI. I hear with the RSP, the equal weight S&P is a little bit weaker. I do see that, but
Yeah.
it's not just AI. I'm seeing retail stocks doing well. I'm seeing software names doing well. There's restaurant names that are powering ahead. There's medical products, even big pharma. It's not just the growth theme from Lilly and Novo. You see Merck, and you see Regeneron, and you see AstraZeneca and Vertex. These mega cap pharmas are at new highs. And before I forget, those pharmas are going to generate $1 trillion in free cash flow in the next 5 years.
Wow.
Merck alone is going to generate $100 billion in free cash flow in the next 5 years. My point being that, let's not forget, there's drug discoveries. These companies want to replenish pipelines, always looking to do M&A, R&D, and so forth. So there's more than just the AI theme. I see 6 or 7 sectors that are still in those growth stages, and I'm just trying to focus on the best.
Great. And so it looks like, if we are seeing technology stocks leading, but it's not just limited to those, what do you think traders should be doing right now with where the market is? We've seen a nice run, not only this year, but the last couple of weeks in particular. I know we're going to get into sell rules, but in terms of holding what's working or looking for new ideas, if breadth is an issue, it seems to me like focusing on relative strength, in addition to strong fundamentals as a key screening criteria, right? But on the technical side, looking for that relative strength to pick your spots. What do you think?
Yeah, I think as far as, over the near term, I've always said, no matter what your time frame is, get those strong entry points, whether you're short, medium, or longer term. So you got to get entry points that are closer to stocks breaking out of bases, or if you miss those breakouts, pull back to support. specifically 21-day, 50-day are good areas of near and medium-term support. But I said in the beginning of the year, I forget if it was on IBD Live, that the average intra-year correction in the S&P 500 is about 14.5%. And I believe at the beginning of this year, I said that the pullbacks are going to be shallow because of a lot of precedents that were there leading into this year, meaning we're going to see 3 to 7% pullbacks. So even if we do get a pullback, I think it's viable. And I do think we're going higher over the second half of the year. But as far as right now, you might want to wait for a little bit of a pullback if you're looking to put money to work. If you're invested and you have a longer term time frame, I say stick with some of the winners, assuming that you're in some of them.
So you're always talking to people through Twitter, and of course you have your site too. How's the sentiment just amongst just normal investors out there? Are they catching some of these stocks, or is there FOMO everywhere? What are your thoughts on that?
I think people are too nervous to buy stocks that they've missed that have gone up. They just feel that it's too late to buy them, but it's also that concept or that rule we've talked about that moves in the market can get exaggerated, can go on much longer than we could ever imagine. So just when you think something can't go higher, it usually does. And it's vice versa. When something can't go lower, it usually does. So I still think, when O'Neill did the studies of the biggest winners, and that key line is the earnings are already on the table. There are some serious earnings that are coming in still this year that are already on the table. And that's before some of these stocks or when they're in the early stages of moves. So again, that's where entry point's very key, and position sizing and so forth. But, I think sometimes when people see stocks going straight up, they're afraid to buy them. And I'm not saying to buy them there. I'm just saying to buy them on, a natural pullback or a pullback to support.
Exactly. Very well said. Buying right solves a lot of the issues with selling, but that's going to be the focus of this week's educational segment. So after the break, we are going to talk to Joe about sell rules that he uses both on the offensive side and defensive side, because we've seen a lot of stocks make nice runs over the last year or so. So when do you stay in? When do you get out? We will talk to Joe about that after the break. Welcome back to the Investing with IBD podcast, everyone. We're here with Joe Fahmy talking about sell rules, and that's a critical part of portfolio management. Joe, selling before you get a big loss. I feel like maybe since the market has run up so much, a lot of people out there may be thinking, hey, why sell this? It's just going to bounce right back, turn around. We're in a strong market. So it's not me. It's not my stock. It'll turn right around.
Yeah, I've been working with people for a long time, both traders, friends of mine, and through my educational product. And I found one of the biggest challenges people have is selling. And it's on both sides. It's selling to the downside and selling to the upside. And we can cover the downside first. Is that my theory is you put in some time, let's say, to research a stock, to buy a stock, although some people don't research at all and will throw 40,000 into a stock that someone tweets or whatever, but that's a whole other story. But my point is that people have no problem buying a stock, or let's say you've researched a stock and then it starts to turn against you. And I think the biggest challenge is fear, because it's a lot of things that are moving parts, which is, but I put in my research and I feel that this is right. And it's a little bit of ego, a little bit of finality. And I think the biggest one, though, is what if I sell and it turns around?
Right.
That is one of the biggest fears that people have. And I kind of come up with just a couple of comments to that. Is number one is you just have to accept you're not going to be right on every single trade you put on, because you can't assume everything you buy is going to be the next Apple or Amazon. There's been tens of thousands of stocks that have traded, let's say in the past, 20 years. There's not that many that have just been amazing winners over the past 10 years. So you can't assume everything that you buy is going to go higher and is going to work out. And the other thing is, let's not forget the ones we sell that go lower. For example, Fastly is one that I've talked about. I was in this one during 2020 and I got stopped out somewhere around 100 to 110. If you pull up a weekly chart, somewhere in that range. And it did very, very well. This is an example of a lot of the pandemic names that did very well, but it corrected down to $8. So if I didn't stop myself out in the low hundreds, that would have been a significant loss. So in other words, we tend to want to focus on the ones we sell that turn around, but we forget the ones that we sell and go lower. But the bottom line is you have to have some sort of sell discipline. Whether it's a number of points down, I'll sell it when the stock drops 5 points, 10 points, whether it's percentage, whether it's a technical stop, you have to have some sort of sell discipline to prevent a major damage to your portfolio when bigger corrections come. And also, I'll default to studying the best ever through Market Wizards and anyone else. Their number one common theme when you do study the best traders is cut your losses, cut your losses, cut your losses. So if the best are saying that, I think it's wise to have some sort of sell discipline on the downside.
Yeah, it's funny that you bring up Fastly, because I was in this stock in 2020, and it sounded like the most amazing story too, right? Edge computing, and this is where everything's
so easy to
going.
fall in love with these stories. Yeah,
Exactly. And so I highlighted a couple of times where I caught some of that initial run, and then it gapped down, I think, on earnings, and so I was forced out of it. It started working again, formed some kind of base. I got back into it, and then I got caught in the next earnings, and it gapped down. I had to cut at that point. Honestly, and after that, I was like, I'm done with this. The stock is too gappy. I haven't looked at this stock actually in a few years, so I'm one of those people who have forgot about this. I didn't realize it got this low. But one of the things that I struggled with initially with the cutting losses is you have to admit you're wrong.
Yeah.
I mean, so how do you kind of get over that initial thing that you don't always have to be right in the market?
I think it's just you learn that lesson quickly. I just think of one word is it's just you accept it. That's it. You have to accept that you're not going to be right on everything. I know your colleague David Ryan has used the word humility, which makes a great trader. And it's a little bit of that. It's accepting a combination, just being humble, accepting you're not going to be right on everything, and realizing that at some point, whether it's because you're wrong on the stock or maybe you're right on the stock, but the market's heading into a bigger correction. And at some point, you just have to accept you're not going to be right on everything. And I think it comes with hopefully, unfortunately, learning that lesson many times and then hopefully making that adjustment.
Yeah. And I've got to tell you, I think this kind of mindset has been huge for supercharging my performance over the last couple of years, and just the thinking that I can always buy it back. I don't have time to spend on the, worrying about, okay, is this stock going to come back? I feel like that can make you spiral, because then it just puts you in, if you're down and digging a bigger hole, that's just not putting you in the right mindset to succeed. You're going to start getting sloppy, taking bigger risks, continue messing up. And so if you just move on, you can always get back in. And there are a number of trades that I've made this year, when we had that little intermediate correction, followed my sell rules. They were winners for me, got out, but I got back in. So I think that's the willingness too, is maybe you are wrong and that is the top and the sell rule got you out. Great. But if you are wrong, if it sets up again, you can always get back in, right, Joe?
Oh yeah, that's a great point. This isn't just selling with finality and taking the loss. It's just maybe the timing isn't right, and if it sets up again, you can always get back in. I think that's a very good point as far as being flexible with the markets and with your ideas.
So Joe, maybe let's go into the next topic, because I think we all have to learn the hard way, or at least I had to learn the hard way, why you cut your losses. Because those first few trades I did 20 plus years ago, I ended up riding them down like 80%. And so I was like, okay, that's why you have an 8% loss, because 8% is a lot better than 80% loss. But what I've found that's taken me a lot longer to learn, and I'm still learning it, is that offensive selling. Because finally, because you're wrong a lot, as you said, you're wrong a lot in the markets, but finally you have something that's working and you're up on it, and it becomes, I've found it becomes a lot harder to kind of sell and get out of that stock, because you're finally right.
Yeah. Before I forget, on the downside, I just remembered another thing is that a lot of people came to me after the bear market in 2022 that said, unfortunately, they had 50 to 90%, losses in their portfolio.
Wow.
Yeah.
And they came to me and they're like, can you help me get my money back? Now, I'm not Chair Powell. I don't have a money printer, so I can't help you get I can't help you get your money back. But what I can help you do is prevent those from the future. Because,
Right.
like Peter Lynch says, over the cycles of time, this X amount of bull markets and bear markets, one thing I can guarantee is we'll have another bear market. I just don't know when. So when it happens, you have to have some sell discipline, whether it's the 10-week moving average, the 200-day if you're longer term, at least something to prevent that. So I wanted to say that before I forget. But as far as the next section on the upside, that is a lot more difficult. That is a lot more difficult because, again, I use that word acceptance. You just accept that you're not going to get the high. You're never going to get the high. You just accept that and be okay with a gain. There shouldn't be FOMO if you made, let's say, 20, 30% on a stock. There shouldn't be FOMO because you made money. What are you missing out on? FOMO's when you're not in it. So there shouldn't be any sort of fears. However, there's usually that common fear. If on the downside, what if I sell and it turns around? On the upside, what if I sell and it goes higher?
Yeah.
So another solution to that is sell a little bit. It doesn't have to be all or none. If you have 100 shares, you can maybe sell 10, you can sell 25, you can sell 50, sell a quarter, whatever of your position, because many people feel when they get into a stock, you have to buy it all. When you sell, you have to sell it all. And you can do partial trades to get in as well as on the upside.
Right.
A perfect example is some fund managers in their mandate, whether it's an ETF or mutual fund, they can only have 5 or let's say 10% of a position is the max that they can have in their portfolio. So they're not selling because they don't like the stock. They're just selling because if a 10% position runs, 20%, now it's 12% of your portfolio, they just reduce it back down to 10. So if as an individual trader, you don't have that mandate, but if a position gets to be too big, you can reduce it down to that original position if it's working out for you.
Now let's talk about an example and walk through, Joe, a trade that you took. I took this trade too. Uber was a nice winner from around that November follow through day. So talk to us about how you handled selling this winner.
Yeah, so this was one I was on, I believe, November 1st. It was right on the follow through day. I got lucky that I was on a follow through day. And O'Neill has a rule on a follow through day, look to buy some of the leaders. And I'd like this name, and it was getting back above the 50-day. So I took a position in this one, and I actually added to it. Another lesson here is when a lot of people say, okay, I have problems averaging up, a great way is when it visits the 10-week.
Yep.
So that's when I added to the position on the visit to the 10-week in January during that pullback in early January. Stuck with it. I had a time frame. This is what I mean by no matter what your time frame is, get that strong entry point. By getting in the 40 to 45 range, I could sit through, 65 down to 57 or 70 down to 62. I can sit through that because my entry point's in the 40s. You can deal with normal price action and normal pullbacks to the 21-day into the 10-week. And then I stuck with it, and it was hanging around there, around that 80 range. And then eventually in April, when it broke through the 10-week, my rule is a decisive close through the 10-week, somewhere around, let's call it 70 to 73 in that range, call it low 70s. I forget exactly, is when I decided to get rid of the position and sell it. So net, it was a great trade, but that's just sort of a way when you take a step back, use a weekly chart, relax a little bit. That's a way to take some of these winners for longer than you can expect by using that 10-week as your guide.
Yeah, it's funny you mentioned the weekly chart, because a lot of times if the stocks are getting a little volatile, instead of looking at the daily, which can make me a little bit more nervous, I'll try to switch over to the weekly, and it'll help me stay into those a little bit more. Now, when you were getting out of it, were you kind of scaling out of it, or when it decisively broke the 10-week, you're like, you know what, let me just lock it?
Yeah, I was actually, because it's we're all human, and you have a stock that's up, close to 100%, done very well for you. There's that rule, don't marry stocks. Sometimes it's hard because it's rare to find a nice winner, and we love the story and everyone uses the product. And when Tesla came out and said they were getting involved in robo taxis, that's what put some selling pressure on the stock. So another lesson there is sometimes the facts can change and we have to be able to adapt. But I was definitely had some, I don't want to say married to it. I love the name. And I did. That's why I said I was out between 73 and 70 is I cut a quarter and then cut another quarter. So I'd half the position. And then when it just kept going down through that range, I gave it a little bit of room below the 10-week. But that's another rule when I say if you're going to sell, let's say you sell half and it's right around that 10-week and you're not sure. If it goes higher, you still have some. And in this case, it went lower. So my loss by getting out a little bit below the 10-week wasn't as bad because I had cut the position in half. So again, just sort of bending a little bit around that 10-week because sometimes it's not so clear cut. It's not a decisive close. It just sits around that 10-week. And by selling half gives you a little bit more clarity.
Right. Very true. And great minds think alike because I handled this one very similarly, which is why I'd love your thoughts, Joe, on Nvidia. I'd love to go ahead and just talk about it now. And full disclosure, I do still own this one, but talk about a tricky break of the 10-week. I mean, this stock is in an elite category, but this is one of those ones where I did follow that rule. That was a very sharp break of the 10-week, but I got back in when it got back above the 10-week line. So with something like this, because it's in an elite category, do you use different sell rules? Do you hedge the position instead? Do you sell and get back in? What are your thoughts on that, Joe?
Yeah, they're all great questions, and there's no right or wrong answer. I actually reduced when it broke through the 10-week in that April 19th low, and then when it regained, I was quick to gain to add back to the position. So I've been holding a core position since 250 or split adjusted around that $25 range. I've been holding a core position and then just adding on in certain levels and then reducing when I need to. So I did reduce, to your point earlier. It's okay to reduce. And my absolute line in the sand stop was going to be the 200-day. So I did reduce, and then when it regained that level and the market stabilized in the second half of April, I did add back. But that's another rule is that some people are longer term, and my absolute line in the sand would be the 200 days. So that would have been my final stop because for this specific idea, I am longer term on it, and that would have been my stop on that.
Right. So just a stellar combination of technical action, the gain that you have on the stock and the fundamentals and the story, giving it that room down to the 200-day.
That's what I would have done with, again, it's not the full position. When I had reduced, that's what I would have done with the rest of it. Yeah.
Right.
I closed below the 200-day would have been my absolute stop. And that's where bending the rules and position size can matter because some people, I always say, if you want to be longer term and you're a nervous trader and you're getting tossed around, just take a smaller position and give it more room because there's no difference between 100 shares that you take for 3 points or 50 shares for 6 points. It's the same $300, but the 50 shares relaxes you a little bit. It makes you calm down a little bit. And that way you're not getting chopped around during normal fluctuations or maybe a quick shakeout in the stock before it recovers.
So with position sizes, do you generally have like 10 positions, 15 positions? What have you found as the sweet spot that works for you?
The sweet spot, I was up to about 20 on average if I'm fully invested, 20 positions, about 5% positions each.
Okay.
I've found about 10 to 15 to be, for me, what's been a little bit better. And then with some of the mega cap names, I've gone more than 5% positions because they're liquid. And if you need to get in and out, it's not a problem. So I vary the position size where some of the bigger names, I'll use bigger positions. Some of the biotechs that are riskier, I'll have smaller positions just because you worry about event risk or not regulatory, but, biotech risk, or in the case of some China stocks, whatever it is, if it's more risky, you have to know the stocks. You can reduce your position size if there's more risk to it. So, but for the most part, I found that 12 to 14, I just can't watch too many stocks.
Right.
That's the other word of accepting. If I manage a $2 billion fund right now, I could easily own 100 stocks, but I don't. And it's okay. And I do try to keep it focused and accept you can't own everything. You can't just be in everything. And it goes back to what I'm saying. Focus on the absolute best. And that's what I try to do. Sometimes I want to sell, let's say, part of my Nvidia to buy something else. I'm like, why am I taking Michael Jordan out of the game? It doesn't make
Right.
sense to buy to put a lesser player in. So I'm just trying to keep it more concentrated in the better names. And even if I see a setup, just accept it's okay. You can't own everything. It's not the first or last time I'll miss something.
All right. Well, any other final sell rule wisdom for us, Joe?
Wisdom, chapters 10 and 11. How to make
Yep.
money in stocks, William O'Neill. That's wisdom. There's plenty of examples, plenty of sell rules. For me, one of the biggest ones I love is selling on the biggest up day. So when a stock, moves $2, $3, $4, all of a sudden it jumps $10, $11, an abnormal move, that's a good time or a good signal to at least take some off the table, but plenty more sell rules in that book.
Perfect. Okay. Well, we will get to a couple of stocks on Joe's watch list when we come back. So stick with us. Welcome back to the Investing with IBD podcast, everyone. Now, before the break, we were talking about Nvidia and sell rules, and there's more to talk about with Nvidia. So why not? It's been a focus for a lot of investors lately, and there's good reason for that. And as we discussed previously, a number of us on the IBD team, including myself, do own it. Joe, I know you've been tracking not only the stock, but the fundamental story with the leading chip maker and leading AI stock for a long while now. So you've done a deep dive. And why do you think that Nvidia has more upside from here?
I think that there's the spend for AI is still in its early stages, and in the past 4 quarters, they've done approximately 80 billion in revenues, and their new GB200 chip, I believe, can get to just that chip alone. That chipset can get from to about 100 to 150 billion in revenues. Even Dan Niles, who runs a hedge fund now, but in the past was one of the best semi analysts out there, he believes that their revenues can triple in the next 3 to 4 years.
Wow.
And I'm with him on that. I do think they can get north of 250 billion over the next 3 to 4 years. Now, of course, now you might say, okay, take it easy. It's not going to go straight up. No stocks go straight up. In fact, when it jumped up, split adjusted from 25 and ran up to 50, it sat between 40 and 50 for 6 months. And then recently, as we discussed earlier, it made another move from 50 to 100 and dropped down to about 75. So it did correct 25% in a short period. So my point being that I still believe in this longer term. I still think it has more upside, but of course there will be corrections and pullbacks in normal bases along the way.
So what are you seeing from the options side? You always like to follow that and what's going on with the puts and calls. Are you seeing anything with Nvidia?
I'm seeing nonstop bullish flows. I'm seeing it's nonstop. There's a lot of institutions. This is the theory I have when they write puts, meaning they're willing buyers if it drops. I don't know if it's FOMO or they just don't want to chase the stock, or they say, I don't know, the stock's at 135 roughly. If it pulls back to 120, I'm willing to buy it. And then they're writing puts at that level. And then if it doesn't pull back, they just collect that premium.
Right.
So I am seeing nonstop put selling or put writing, which is my interpretation. They're willing buyers if it goes down, but this isn't just, 10, 20 contracts. It's 1,000, 2,000, 3,000 contracts. That's a huge institution that is a willing buyer. And in my view, it puts a floor underneath the stock. A very interesting trade, which I thought was insane at the time, was February 28th, 29th of this year. Remember, it was a leap year. The stock was at 775, so 77.50 split adjusted. Someone came in over those 2 days and bought 2,800 of the December 2026 1640 calls. So just to put in perspective, forget the 10-for-1 stock split. The stock is at 775, and they bought 2,800 of the max strike, max expiration calls for $75. They just said, what's the farthest option on the chain? And they put $21 million into it. I mean, that's not your grandmother doing that trade. That's like, what's insane is that they closed that trade on June 6th for $283. So all of those options they bought for 75. The stock never got to 1640 split adjusted 164. It just, as it went up, they closed that trade from 75 to 283. But wait, there's more. They didn't just close it. They rolled it
Rolled it.
into December of 2026, 2280 calls for $172 a contract. So they took the profits and rolled it into a $73 million trade. You can interpret this however you want. My interpretation is this person has been dead right, whether assuming it's an institution, and they are sticking with this one for December of 2026 is about 2.5 years from now. So that to me is insane conviction in the options market.
And Joe, you mentioned the stock split. How much do you think that's playing into the bullish fervor that we're seeing here?
I know a lot of people think stock splits are garbage. My interpretation is it's a company telling you that there's good prospects going forward, because you wouldn't want to split your stock 10 for 1 from 1,000 to 100 and then have it drop to 50. So same thing with Broadcom, same with Chipotle. Some of these companies, I know it seems like excessive stock splits when O'Neill talked about that being dangerous. Back then, the stock would go to 100 or 200 like Cisco and split 2 for 1 and then again 2 for 1. Now they're just waiting longer. I don't know why, but I think it's a bullish indication from the company that there's still more growth ahead. And again, now would I buy it? No, I've talked about this forever. So I mean, I would at least, for me, if you're in it, I'm sticking with it, taking some profits along the way. And if you're not in it and you're looking to get into it, I would wait for some sort of consolidation or some sort of pullback.
And Joe, I know with the options flow, you're looking at those big orders in the institutions. Retail investors clearly aren't having that level of an impact. But that's the other thing with these stock splits is it does make owning these stocks through options more accessible. So do you have a take on that aspect?
Yeah, the day it split, there were so many new trades coming in, because not only for options wise does the split make the trading cleaner, but for shares wise, for retail to get in, people don't like high price stocks, not high valuation. Just people say, why am I going to buy a $2,000 stock? Why am I going to buy a $3,000, even a $500 stock? Because people love the high of owning a lot of shares. That's my feeling as to why people love penny stocks, to say they own 50,000 shares of a stock. Well, it's trading at 2 cents. Like, that doesn't impress me. But my point is that people feel better owning more shares and are more comfortable buying. It's a psychological thing. So I think that benefits as well for getting retail investors to have more shares.
So anything else that listeners should know about Nvidia?
No, I mean, it's still early stages. Taiwan Semi is another one that they produces a lot of the chips, and Jensen Huang has been in the news going there a lot, talking about doubling the capacity. So there's a lot of ways to play this as well, but it's not just one company. It's when you start hearing about the other companies working with them, data center and capacity and chip equipment and all that, collectively, they're all sort of on the same page. So I think it's part of this semi and AI boom that we're seeing.
Well, another chip sector name you're watching is ARM. So let's go there. Trades a little bit differently than Nvidia, but why should we be focused on ARM?
So they get a lot of revenues from royalties as well, and Nvidia is the master, or dominates the GPU, the graphical markets. That's been shifting over the past 10 years or so from CPU to GPU, but you still need that CPU compute power, and ARM is in the new Nvidia chipset. It's a combination of CPUs and GPUs, and ARM is providing this. Now, Jensen Huang, who I believe is arguably one of the smartest people in the world, he knows this. He wanted to buy ARM at a 40 billion valuation, and the regulators, I forget if it was the EU, the regulators blocked the deal. But he knew that this was going to be part of his vision. And looking at it now at 40 billion valuation, it's close to 180 billion. He knew what he was doing, just like his strategic buy of Mellanox. The Israeli company at the time was one of the leaders in data center chips, and he knew what he was doing there, as that revenue has grown 300-500% since that acquisition. So I like that Jensen Huang wanted to buy them. He's using them in their chipset, and the royalty growth from other companies. I think it's about 37% royalty growth right now. So that's pretty solid growth for this company.
Okay, so the story is there, but let's talk a little bit more about the chart because speaking of bad breaks below the 10-week line, in 1 week, in about mid-April, ARM down over 30%, sharply undercutting that 10-week line. It's bounced back pretty fast though, but how do you account for that kind of break in the stock?
I have a theory when something goes straight up in the air, when it went from 70 to 160, the whole world sees it. So everyone plows into it. And I view this, it's not fun. I view that break as a shakeout. It just shook out people who were late to the party or maybe didn't have a good entry and so forth. I was in it and did get stopped out around that 120 range because I have to have my rules. Because all these things I'm saying, by the way, of how I'm bullish on this and bullish on that and the flows I'm seeing and all that, please keep in mind, this isn't blind bullishness with no risk. There is that huge thing of adapting to the market. So we could do this podcast sometime soon in the future, and my whole story could change if the facts change. So I'm just stressing this isn't just blindly being bullish. You have to adapt. And in this case, I love the story, but I have to respect the market. So I got stopped out when it came back out, came back around, was tightening up around that 50 days when I got back into it. And as far as unusual options activity, just this week, same thing. Someone came in and bought December 2026 240 max, not max time frame, max strike, huge trade on that one, $56 option. So that's no joke. I'm amazed. I don't know what's crazier, that they're priced at $56 or someone's buying them. I don't know what's crazier, but that's basically saying it has to get to 300 again. December of 2026 is 2.5 years from now. I think the thing can double from here. But this is not tomorrow. This is not by Friday. This is not by the end of the month. If you relax, have a little bit longer of a time frame, I still think, again, part of that theme of early stages of AI, I think this can go significantly higher over the next 2 to 3 years.
So the stock has gone on an amazing run over the last few weeks. What should people, if they're not in it right now, how should they be treating this stock? Should they be, because it is breaking past that 164 area, should they be buying here or should they be waiting for a pullback?
Depends on your time frame. That's the questions. I know you guys get them on IBD Live, and these are the constant questions that are, the answer is it depends. There is no right or wrong answer. If you wanted to start with a light position and you have a 2-year time frame, I'm okay buying it here. If you're a shorter term trader and entry point's more important to you, I would wait for a pullback. So that's where I always say, anyone listening, that phrase, know thyself. Know if you are your time frame, your age, if you are retired, if you can watch the market full time, if you're in Europe, if you're in Australia, if you're in the Middle East, if you're in a place where you can't watch the US markets closely. All of these are variables to answering these questions. But once you have a plan and know your time frame, it really helps with that clarity of, when to buy and so forth. But as far as for a trade, I would wait for this one. I was getting back in when it was tightening up around that 50-day. That would have been a better area. Yeah. But I would wait for a pullback as far as for a new entry.
Yeah, really nicely done. And I mean, I think things come full circle, right? It also means that if you're buying here, I mean, wherever you're buying, you have to have the sell rules. Like you said, you have a plan, have the sell rule. You could be super bullish and have a 2-year time horizon, but it could fall apart tomorrow and trigger a sell rule. So that's a key.
I could confidently say in 2 years, it's going to have multiple significant corrections. So, I mean, that's just sort of that's with any stock. So when I'm talking about these longer term moves, it takes time for these moves to develop with corrections along the way.
Yeah, because you have to be realistic, right? So even if you're bullish. So
exactly.
Let's move on and talk about NetApp. This is NTAP, and this is in the data storage group. A really nice double bottom breakout a couple of months ago. So another strong price performance by NetApp.
Yeah, I mean, data, AI is all about data and storage, and NetApp is one of the leaders. They have a new keystone product, which is storage as a service. So some of these are moving towards higher margin business. That is growing at triple digits. Their cloud storage is growing about 38%. I think this is a great way to play the need for storage and data and so forth for processing and AI and all the applications that come with it. I think it's a great way to play AI that is not really talked about as much as far as the storage space. I don't want to make a prediction and be crazy here, but I wouldn't be surprised. I actually think this would be a great fit, whether it's them or Pure Storage. It'd be a great fit for Nvidia. I'm not saying
Interesting.
they're going to buy them out, but I'm going to say maybe that could happen. I think it'd be a great fit for the whole AI play.
So talking about that whole industry, Micron, you mentioned Pure Storage, Western Digital. Yeah, how do you generally, like, if you see a group move like this? And I didn't even realize it's all the way up to number 2 now, but the whole computer data storage industry group is at ranked number 2 out of 197. How do you kind of manage that? Like, if you want to get exposure to that, how do you select a stock from that group?
I think two choices, they're not the only two, is you can keep a concentrated group of the best. And like I said, just accept you can't own them all.
Hmm.
So I'm okay with that phrase, keep your eggs in one basket, just watch the basket closely. That's one way to do it. But that means that you can make decisions, you can watch the market closely, and it's, you're able to focus on them. Another way, which I think is easier, is to buy an ETF, an SMH, which gives you exposure to Taiwan Semi and Nvidia and AMD and all of these names. That's a way to play as far as the chips. With storage, I'm in full disclosure, I'm in NetApp and Pure Storage because I just say, okay, I can't own every single storage name, but I want to be in two of the industry leaders that have more customers, more traction and so forth.
And Joe, can you talk a little bit about the option contracts? You said there were for Nvidia and ARM, the max strike, max expiration. What are some of the
Yeah.
other stocks that you're seeing, with this sort of option flow?
I'm seeing a lot of options flow. I mean, as far as NetApp, there was a huge 5,000 August 130s that was bought a little while ago. As far as flows, it's been consistent in those names that I've mentioned. Micron, that Arusha mentioned, Micron's one that's seen consistent flow. And ARM has. Nvidia on the software side. There's a lot of put writing on Microsoft because Microsoft is another way to play, the AI theme. With software taking a hit, I'm always paying attention to relative strength, and Microsoft is one of the ones that has held up very, very well. So that's another one. And in general, to your point, Arusha, about, okay, if your head's spinning, which one do you buy?
Right.
You can just have a broad exposure to the Qs. The Qs gives you broad exposure to a lot of these names with just an ETF, so that if you have trouble saying, okay, I don't want to watch too many names or I don't want to be too concentrated, an ETF is a way to solve that.
So, do you have any thoughts on diversity of leadership within the portfolio? Because, I mean, we talked about 3 AI related stocks in different groups. We talked about data storage versus just the straight up chip space. But clearly, if NetApp is a potential acquisition target for the likes of Nvidia, there are other themes to watch. But do you let your portfolio lean a bit more tech or more AI, just given that that's the dominant theme right now? Or how do you balance that leadership with other groups?
Yeah, I have exposure to other groups. It is concentrated in that theme, but I do have exposure, as I mentioned earlier, to some restaurant names, to some big pharma names, to some medical product names, some biotech as well, aerospace and defense. So those, I mentioned that when everyone says the breadth is narrow, there are, I believe, 6 or 7 sectors. There's others that I just made a decision not to trade. Nothing against them. Like, I don't trade the solars. It's more of just I can't own and be focused on too many things. So, but I do have exposure to other sectors to balance this, so that when they come down, hopefully some of the other sectors will help give that barbell approach, as they say.
Yeah, and honestly, I mean, going off of that, I think that's why what makes kind of the way we do things, uh, really helpful. If it's a narrow market, that's okay with us. You can have a little bit more concentration in AI and some restaurants and things like that, because as long as you manage your risk, right? I mean, I think these type of environments put the individual investor at an advantage versus an institutional who, if you're a small cap fund manager, it's pretty hard to kind of outperform right now.
Yeah, I mean, I'm a fan of adapting to what the market gives you. In 2007, I joked with my friends like it was Google, Apple, and RIM,
Right.
research in motion, and that's all I traded. And then everyone's like, "Oh, that's that easy." I said, I'm trading what's working and what's going
Mhm.
up." And yes, it was getting thinner and narrower into that top in roughly whatever it was October of '07. But all of '07, that's all I traded for the most part. So I'm okay keeping it focused and concentrated, but I'm also super, super flexible that when I see warning signs, or to go back to the sell rules, taking some off into strength, or when
Right.
things break, I will be quick to exit these if I need to.
Yeah, because I remember you were telling us that you were doing that before that 3 waves down type area last, what was it, fall,
July,
summer,
July
fall?
of
Yeah, July. Yeah, you were.
third week of July of '03. Yeah.
Yeah, so you were taking some profits there. What's going to be your next signal to, I guess, on the index level to take some profits into strength, do you think?
There's a lot of just great flows into July and August. And as far as seasonality, I know we didn't talk about this. Sometimes it can be mixed where the summer's slow, but in an election year it's strong. So I still think that there's a lot of liquidity out there, and I don't think we're going to see a major, any sort of major downside into the election. With the economy, I think they want to keep things going with the liquidity. So I just think, again, I'm sticking with shallow pullbacks in that 3 to 7% on the S&P range, and just doing my best to manage the positions that when we get a little bit extended, taking some profits with some cash to put to work on support. It's not for everybody. Not everyone's active, but that's where, position size and knowing your time frame can help you with those decisions.
Yeah, and maybe just very quickly, let's go to that seasonality chart, and just maybe further expand that. So what are your thoughts on what the seasonality chart that we're going to pull up here in a second
Yeah.
from Ned Davis?
Yeah, it's a great chart on the 4-year presidential cycle from Ned Davis Research, and it shows that June, July, August, you tend to get a run up. It's just a theory that I don't think they want the economy to collapse. No, it's not a political statement. Just ahead of an election, there's a lot of uncertainty. So the Fed does provide liquidity, and maybe we're going to get a rate cut as well. That'll help. So you do see seasonal trends into the election, and then after the election as well, because there's clarity. It doesn't matter who's in office. It's just we're done with it. So I do think we're going to see, again, strength into year end with some uncertainty around the election, but the liquidity is going to override that, in my view.
All right. Well, thanks, Joe. Always great insights. And thanks for the bonus market analysis in there. Appreciate your thoughts.
No, thank you so much. Always a pleasure.
And Arusha, great seeing you as well.
Definitely.
That was fun.
Yeah, come back. We'll send Justin on another vacation soon.
Sounds good. Well, thanks, guys. And thanks, everyone, for tuning in. And make sure to join next week, where we will have special guest John Kosar of Asbury Research back on the podcast. He loves looking at the different sector ETFs and asset flows, in addition to other modeling work that he does. So looking forward to that discussion. We'll see you back here next week, everyone. Thanks so much for watching.